I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park. Her popular blog is Juggling Dynamite, and she's the president of Venable Park Investment Counsel Incorporated. Welcome to the show, Danielle.
Hello, Jim.
Ross Kay, our popular real estate consultant who we chat with frequently, has told us that the first cracks in the Vancouver real estate bubble are starting to appear. People are lowering what they want for their houses, and that's the first time we've seen that kind of news in 5 years. Is that the first time that we should be paying attention to perhaps affordable real estate may reappear?
Well, it's interesting to hear that about Vancouver because my meetings with people about the Toronto market are not, I don't think, showing that yet. You've still got a fevered clip of people in bidding wars and gobbling up properties. So it's interesting. We know that this has to exhaust itself at some point after you've had minuscule interest rates for years and years already, and after everyone that's going to buy highly levered is already bought, and then you've got this downturn. You know, I think it happens all over at the edges. So you have a downturn, for example, in the retail sector, right, which is being driven by supply of most consumer goods. Falling sales are being reflected in the fact that people are over indebted now and want to spend less and have less disposable income, as well as the fact that retired people are being squeezed with low yields on their savings, and all of a sudden people are consuming less. So you see stores having mass liquidation sales everywhere you look, and I think that's at the edges of what's going on here. Is that there's just less consumption in the society, and that's going for high concentration centers like Toronto and Vancouver, as well as outlying areas. And then all of a sudden you have more leasing space coming up. You have people starting to lose employment in the sectors that were on fire the past 5 years, because we know manufacturing's been in decline, commodity sector's been laying off people, energy, all contracting jobs. Retail and restaurants have really been at the big leading edge of whatever jobs have been created in the past, say, 7 years. And again, I think that this general compression of sales and ability and willingness to spend is showing up in a compression in all those areas, and that starts having people looking to migrate, not only to find more affordable housing, but to follow jobs. And they tend to, start either as tenants giving notice and seeking to move out. And then, of course, the problem with the valuations that we've seen in many of these hot markets is that on an investment perspective, they make 0 sense whatsoever, right? The cap rates are pathetic. The yields make no sense. If you do a full cost accounting, you're basically in a negative yielding scenario when you're purchasing much of this real estate at these levels. So a lot of people thought they were, quote, investing by buying overvalued real estate with low rates, and they're finding out that if they can't sustain enough cash flow and prices have stopped going up, all of a sudden they're looking to sell. And I think the other massive factor here is that the municipalities all over North America are looking for tax revenue. Some of this is driven by just deficits in general, as I say, less tax dollars being collected in businesses as well as households, but also because the property taxes have escalated so much with this housing bubble in the past, 8 years, people are already paying, much higher taxes than they were 5 years ago. But as municipalities look for places to grab income from, they necessarily go back to tax paying, like property taxes, because land transfer tax has been such a huge part of the budget. As soon as that transaction starts to slow down, or the number of transactions start to slow down, they are noticing a pullback in their revenues there, and so they look at how can we raise capital. So I think, you've seen this in the United States already in many municipalities where they have made these obligations on, for example, public pensions, which are, the CalPERS, the California Pension Fund, just had its last fiscal year end at the end of June 30. Their actual return, Jim, was 0.6 as an annual rate of return. Their target is supposed to be 7.5. So as yields have come down on money and bonds are paying a fraction of what they were even 5 years ago, all of the expectations for returns in savings and in pensions all over are coming in under where they were supposed to be, and this is pushing municipalities and states and provinces, everyone having to raise capital. And I think that expense is just going to slow the economy further. So it's a very complicated web. And sorry, I know you started asking about Vancouver properties, but I do think that when the property values, I think the response of many people to this environment is going to be to say, okay, I'm going to blink, I'm going to sell. I don't want to face rising property taxes. I can't afford it. I'm on a fixed income. My income's lower because rates are lower, and governments keep wanting to increase my property taxes. My maintenance costs are high. I'm going to downsize, and everyone starts to look to sell. And that's when you realize that the greater fools have already bought, and that the people with liquidity and a math discipline around valuation and investing are not going to want to buy anywhere near these levels.
Yes, and where I live in Burnaby, Metro Town, the big crisis here is all these older 3-story walk-up apartments are being demolished left, right, and center to make giant condo towers. Where are those people going to live?
And they are going to have large monthly fees, right? Because property taxes are part of that, but also just because there's going to be, all this funding required to complete and they've got these, valet type services and state-of-the-art gyms and state-of-the-art pools. Well, this is all very pricey, credit bubble style amenities. And so once you get to paying for all that over time, I think people will find that it's a very expensive thing to do. And it only made sense to them to the extent that values they thought were perpetually increasing. Once they realized that they bought the top of these realty prices, or worse, that things are mean reverting, now they're mad, right? Because now they're they're paying for this level of amenity. They're paying for realty taxes as if properties are worth X, and the property has declined from X significantly.
Well, one of the pieces of advice Ross Kay gave us, the real estate consultant, was appeal your property tax assessment, because he said 90% of them are overvalued. They're based on the value of the best 10% of the stuff in your neighborhood, because that's what sells first and always. You probably are not in that top 10%. He said it will save you money for the next decade if you go and do it. He said the price of getting your property reassessed is truly worth it. And if property values now are going down in sales, there's proof that there's less value all around you.
And there's absolutely people who are retired or semi-retired or underemployed right now who have really, truly nothing better to do financially with their time than go and get some of these fixed costs reduced. So I agree. I think it's going to be a booming business. It's going to make financial sense for a whole bunch of people to go and make application for these reductions. But then we go back to the problem of fixed costs on the government agency side, and how many of them have really ramped up their operations and their employment roster and everything in the credit bubble over the past few years. And so now we're looking at, probably downsizing a lot of that government arm as well. So it's this it's a retrofitting of current levels, because the credit bubble has been so invasive. It's really been through all sorts of aspects of our economy, and unless you think about this in great detail, many people are unaware of the interconnections. and the fact that all these things have grown kind of misshapen and too large, and that they all have to mean revert and come back down. So we're not just talking about prices in real estate, we're talking about asset markets, financial markets, equity prices. Commodities are taking another leg down. Today, Jim, price of WTI oil is back under $44 a barrel. I wouldn't be surprised. I think what's at work here is the Brexit contagion, the fear in Europe, the U.S. data being relatively stronger than most other places in the world today is putting a bid under the U.S. dollar again. The fact that the Federal Reserve has not come out with another form of monetary easing at this point, when other governments like like Britain is promising to roll something out this summer because of the whole concern about that economy, which was slowing way before the June 23rd vote, by the way, Jim. But everyone's using that as a scapegoat or a reason why they're saying that the British economy is struggling. Meanwhile, we haven't even seen the changes that are supposed to come in the next 2 years yet. So that's kind of all nonsense. That the economy was slowing well before this. But you've got the same story playing out all over the world, and so you have a relative bid for the U.S. dollar again. I think that the Federal Reserve this week may well say that they're still thinking about hiking in September. And I think you may set up for a very familiar seasonal pattern here as to what we saw in the last half of last year, where oil, the U.S. dollar strengthens once more for all the reasons we've just mentioned, and in the process, commodities weaken, the CAD weakens. We're seeing this push into investment-grade bonds in North America over the past while. Government bond prices going up, yields coming down and down. It reminds me in many ways of what we saw in the summer going into the fall in 2008. You had a U.S. election cycle then teed up as well, and you had valuations at all-time highs. You had a lot of reckless capital flows in credit markets, a lot of subprime floating in the system. I think we're in a very similar place today, and all that the central banks have really done the past few years is extend and pretend and get, more credit into the system, but the healing process is actually allowing the mean reversion in these asset values. That's when, reasonable finances are restored, where the actual income statement makes sense again, where people are paid for some risk to their savings, where there's something like $55 trillion of cash presently sitting out of asset markets, just biding its time and waiting for something attractive to spur it coming, in and purchasing things. And I would suggest to you that the price that capital will be attracted in at this point is probably 30 to 50% lower than current valuations and prices. So that, for anyone that's keeping an eye on the big cycle, sees the interconnections of all this stuff, has maintained liquidity, doesn't listen to the talking heads on the business stations, they're starting to get rather excited about prospects of opportunity again, just as we were sort of in the summer of 2008. Now, whether or not there's a lot of talk about this helicopter money and everyone running around thinking that feds are going to literally drop money into households and small businesses. First of all, that's not, what what Milton Friedman meant when he talked about that whole concept of helicopter money, which was in these papers he wrote in 1969. But it's basically a way to get a fiscal boost into the economy. And so I don't think it'll be magic, and I think that if they do it, it's the last final effort of monetary policy. But in the meantime, you've still got a mean reversion in the economy happening, and I think that's where the rubber hits the road in terms of this coming back to relative value, and that means lower prices. So it's one of those times where there's risk everywhere you look. This is what I would classify as the everything bubble. We had the tech bubble in 2000, the commodity subprime bubble in 2007-8, and I think today we have the everything bubble, just about every asset class. So people ought to be very careful that they aren't seduced to the dark side, reaching for a teeny bit more yield at the sacrifice of their principal.
We'll have more with Danielle Park right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Danielle Park. Danielle, I'm curious, what if the Canadian government decided as part of its stimulus program they would give $10,000 to every Canadian?
Well, it's interesting. It reminds me, wasn't it Ralph Klein in Alberta who gave everyone $400 as a tax rebate? Was that in 2007 or 8? And people went out and bought a flat screen TV or whatever. You think forward now, with Alberta facing deficits, that was exactly the wrong thing to do, because what you're supposed to be doing in the prosperous times when you're making much more revenue than the average amount is pay down debt and build up savings and invest in productive activities. So this idea that you can just dump a cash sum on an individual and have consumption jump is fallacious for a few reasons. First of all, because when they talk about these dumps of capital or the theory of helicopter money, it's supposed to be in the form of a fiscal stimulus, which means either a tax cut or some kind of a increase in public spending. And the problem with the idea of giving cash to a Canadian today, for example, with the average person massively undersaved and massively over-indebted, what happens is you're discounting the reality that people in these conditions are more apt to take that capital and spend it on paying down a debt than they are to increase further consumption. Obviously, some people will go out and buy something, but the chances of that being a productive investment, i.e. something that's not just for pure consumption in the short run, where you might get a quick bounce in short-term consumption numbers, but unless it's doing something productive like building a business or investing in infrastructure or, putting on solar panels that are going to lower your costs going forward, something that will actually increase cash flow for the future. If it's not doing that, then all it's doing is adding to the fiscal deficits at the present time, giving you a short-lived bump in perhaps some consumption numbers, but for most people, it would be about paying down debt and building up savings, which is all longer-term restorative. I'm in huge favor of that idea of building up savings and paying down debt, but just doing it from a lump sum from a government program is not going to cut it. And even if people did pay down their debt with the money or save it, you're not going to get the boost to consumption that everyone's expecting for the economy. So it's not as simple as throwing good money after bad. You have to be strategic and intelligent in an investment perspective to build value over time. And that's why I think this whole idea of helicopter money, first of all, it's like considered very rogue, and it's very risky to the reputation or credibility of anyone who advances it in seriousness. And secondly, because I think it's doomed to fail for the reasons I've just said.
The G20 finance ministers just said they are willing to use all of their policy tools to ensure the economy stays healthy. Do they have any more policy tools to use?
Well, fiscal side, that's what they're talking about, because they're the politicians. So they're talking about increasing government spending programs as a way of trying to get transfer payments into households and businesses, or they're talking about cutting rates, essentially, because everything else that they do, whether it's a long-term, whether it's building a new, grid or building a new dam or anything that they would do, is essentially all for longer-term benefit. There's nothing that's going to give you a short pop of, what they're trying to do is they're looking at weakness all over. They're seeing economy's turned down. They have been turning down since 2014. There's every indication that the world is very likely already in the midst of the next global recession. Of course, we never declare these things until retrospectively, but many of the leading indicators are already suggesting that we're likely in the throes of this next recession. So the governments are already in the midst of a downturn in their tax revenues coming in, and now they've got to turn around and figure out ways to spend to try and stimulate, but ultimately they're just, robbing Peter to pay Paul, and they're pulling forward spending that would have happened again in the future and trying to spend it now as kindling for a fire they're trying to start. At the end of the day, these policies are just wasting money because it's not having the effect. When you're this indebted and this under-saved, you just need to go through a downturn, a period of reset, and realize that that's a healthy, necessary part of this cycle. And until we allow that to run its course and asset values to come back down, we're never going to get to the next organic boom phase. And we will get there because it always happens that they think they're in command of the fiscal policies or the monetary policies, and at the end of the day, consumption's in demand and it's falling, and that's really the end of the story. So, I don't have a lot of faith. I think they talk a good game, but the reality is that governments don't drive the economy. Consumers and customers drive the economy, and you have to look at what is actually happening with those consumers and customers of businesses everywhere, and that's where you're looking at aging demographics and pulling in because they want to lower their expenses, both because they're getting older and you want less, and because they're making less on the savings that they have, and that all the younger people are heavily indebted. All those things push down consumption over time, and so it should, because we need a healing period. So the best thing that governments can do at this point is stop thinking that they can force more reckless behavior and that that's somehow going to save anyone. It's actually just doing harm after harm after harm.
Danielle, thank you so much for your time.
Thank you very much, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward questions to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.